This video is about how to start investing for beginners. To get started investing, pick a strategy based on the amount you'll invest, the timelines for your investment goals, and the amount of risk that makes sense for you. 5. What is investing? Investing means setting some of your money aside for the future and putting it to work for you. When you invest, you're buying into something you believe will increase in value over time. Investing has the potential to generate a better return than a savings account. While your money's not locked away, you should be prepared to set it aside for at least 5 years to give it the best chance to grow. And keep in mind, the value of your investment can jump around, so you could get back less than you put in. Instead of overwhelming you with the entire investment universe, let's focus on two well-known ways to invest: funds and shares. 4. What are funds? Funds are a ready-made basket of investments. When you invest in funds, you're buying into a mix of assets, which may include shares, property, government bonds, and cash. Funds save you from trying to pick investments individually that you think will perform best. The great thing about funds is you're not putting all your eggs into one basket. Instead, your money goes into a range of investments. This is known as diversification, and it can be an effective method for spreading your risk. That's because if some of the investments in the fund perform badly over a certain period, others may perform well. There are two main types of fund. An active or multi-asset fund is run by a professional fund manager who chooses which shares, bonds, or other assets to hold and monitors them on your behalf. You pay extra for the fund manager's expertise with the aim of receiving returns which outperform the market. A passive fund or index fund simply follows or tracks a given market or index. As there is no active involvement from the fund manager, passive funds generally charge less in fees. Funds vary in risk from cautious funds at the lower risk end of the scale to adventurous at the higher risk end. If you're younger, you may have more turn on your side to ride out any turbulence, so you might want to consider a more adventurous fund. As you get closer to retirement, your investments could have less time to recover from any dips, so a more conservative fund may be more appropriate. 3. What are shares? Shares are units of ownership in a company. When you buy shares, you're effectively buying a small stake in a company. Companies sell shares to raise money, which then they use to expand their business. Investors, known as shareholders, are then free to buy and sell some or all of those shares on the stock market at any time. If the company performs well or is expected to perform well, demand for its shares will generally increase, pushing its share price up. If the company does or is expected to do badly, its share price will generally drop. Interest rates in the wider economy can also have an impact on share prices. As a shareholder, the value of your investment rises and falls with the share price. So while the money you invest has the potential to grow, it could also fall in value, so you may get back less than you invest. 2. What do you want from an investment? There are two main ways you might make money from your investment: via growth, also known as accumulation, or via an income. If you're considering funds, this means choosing between an accumulation or income fund. With an accumulation fund, the income generally is reinvested within the fund, meaning your investment will be more likely to grow in value over time. With an income fund, any income the fund generates will be paid directly to you. Investing for growth could be good if you're able to invest over a longer period, as accumulation funds may provide you with a greater return in the long term, whereas investing for income could be a good shorter-term strategy if you're nearing or in retirement. By choosing funds that pay dividends, you could receive regular payments to boost your existing income or pension. 1. Takeaway investing tips for beginners. Investing is for the long term, ideally for 5 years or more. The higher the potential rewards, the higher the risk of losses. You don't need to pick your own stocks. Many first-time starters investing in funds. Diversification can lessen the impact of one's investments performing badly. Start as early as you can, so your money will have more time to grow. Do let us know in the comments if you've more tips for investing. Thanks for watching.